Everyone's talking about AI. Every headline, every tweet, every stock seems to skyrocket overnight. But while the world is hypnotized by the AI boom, another story is unfolding quietly in the background. A sector that has already exploded over 70% this year, and most investors haven't even noticed it yet. The twist? It's not another tech play. It's nuclear energy, the green power backbone fueling the AI revolution and the future of digital infrastructure. And this wave is just getting started. So today, we're diving into one of the market's most overlooked booms, nuclear energy. In the next few minutes, you'll discover why uranium, the fuel behind every nuclear reactor, is being called the new gold, and how this quiet rally could reshape the global energy game. Then, we'll break down the 5 best nuclear ETFs, carefully chosen from dozens, that give you instant, diversified access to this once-in-a-generation trend. By the end, you'll know exactly how to capture this nuclear wave and potentially supercharge your portfolio for years to come. Picture this. Around the world, nations are racing to secure clean, reliable power. Energy that doesn't vanish when the sun sets or the wind dies. And suddenly, the one technology everyone wrote off as old and dangerous is making a comeback. Nuclear stocks aren't just heating up, they're going nuclear. Just look at this chart. OKLO, a leader in small-scale nuclear generation, has skyrocketed over 1,000% in a single year. Others like LTBR and SMR have surged hundreds of percent too. This isn't a rally, it's a liftoff. So what's driving this explosion? It's not hype. It's 3 unstoppable global forces. First, data centers and AI are consuming electricity like never before, and nuclear is one of the only sources that can run 24/7 without crashing the grid. Second, the world is going electric. Homes, cars, factories, and renewables alone can't meet the demand. Third, governments everywhere are racing for energy independence. With geopolitics getting shaky, nuclear suddenly looks safer than relying on foreign oil or pipelines. According to Bank of America and Bloomberg, over $3 trillion will be needed to triple nuclear power capacity within 25 years, with $350 billion coming from the US alone. That's not just growth potential, that's the foundation for the next energy supercycle. The biggest challenge to this global nuclear boom isn't technology, it's the shortage of the one element that makes it all possible. Uranium. Take a look at this chart. Over 30 countries are planning to triple nuclear capacity by 2050. Demand for uranium? It's almost going vertical. But supply? Flat, barely moving. In fact, it's starting to decline. Why? Because mining can't keep up. High-grade deposits are running dry, new projects take years to develop, and producers are cautious after a decade-long bear market. The result? A perfect storm. Uranium miners are now selling into a market where everyone needs more supply, and nobody has enough. This is the classic setup behind every commodity supercycle, the same kind of squeeze that sent gold soaring in past decades. But here's the key difference. Gold just stores value. Uranium powers the world. So instead of betting on one lucky mining stock, why not invest across the entire nuclear supply chain? In the next section, we'll reveal 5 powerful nuclear ETFs designed to capture every angle, from reactor innovators to uranium miners, fuel suppliers, and energy operators. Let's start with your all-in-one nuclear boom bet. First up, NUKZ. Officially known as the Range Nuclear Renaissance ETF, this isn't your average clean energy fund trying to do a little bit of everything. NUKZ goes all in, laser-focused on one theme: nuclear power. It tracks an index that covers the entire ecosystem, from uranium miners and advanced reactor builders to fuel processors, utility operators, construction firms, and the service companies keeping the grid alive. In short, you don't have to guess whether the miners or the engineers will win. NUKZ owns them all. Despite being new, it already manages over $600 million in assets, a clear sign that investors are waking up to this trend. Its expense ratio sits at 0.85%, a bit higher than a vanilla S&P 500 ETF, but you're paying for targeted access to a booming niche. Now let's be real, this isn't a sleepy dividend fund. NUKZ is concentrated, high-octane, and theme-driven. If nuclear sentiment cools or regulators change the rules, it will feel it. Many holdings are small, innovative firms, meaning the ride can be wild. But here's the thing. When an entire sector is going vertical, concentration can be your best friend. If uranium truly is the new gold, NUKZ gives you a front-row seat to the entire nuclear renaissance without betting on a single stock. You're not just picking a winner, you're owning the whole race. URA. If NUKZ is the all-in-one nuclear ecosystem, owning everything from miners to reactor builders, URA is the pure uranium play. Officially called the Global X Uranium ETF, URA is the veteran heavyweight of this space, controlling over $5 billion in assets, the biggest and most liquid fund in the nuclear world. When hedge funds or institutions want uranium exposure, this is where they go. But unlike NUKZ, URA narrows its focus to the producers themselves, companies that mine, refine, and supply uranium, heavyweights like Cameco, NextGen, and Kazatomprom, the ones literally fueling reactors worldwide. The expense ratio sits at 0.69%, cheaper than most niche ETFs, yet every move follows uranium's price swings. When the commodity climbs, these producers lead the charge. So if NUKZ gives you the whole nuclear value chain, URA gives you the core fuel, the purest way to play uranium's bull run. Think of NUKZ as the orchestra, and URA as the drummer driving the beat. And coming up next, an ETF that adds an entirely new twist to this nuclear story. URNJ. If URA is the heavyweight champion of uranium producers, URNJ is the adrenaline-fueled sprinter. Officially called the Sprott Junior Uranium Miners ETF, this fund skips the big established names and goes straight for small and mid-cap uranium explorers, the kind that can double or triple before Wall Street even notices. It manages about $400 million, and that smaller size gives it agility. When uranium momentum hits, URNJ moves fast. The expense ratio is 0.80%, a touch higher than URA. But what you're really paying for here is pure upside potential. If uranium prices keep climbing, these junior miners often rise exponentially more than the majors. But make no mistake, this isn't for the faint-hearted. Junior miners live and die by drilling results, fundraising, and government approvals. A single headline can send them soaring or crashing. Still, in every major commodity boom, it's the juniors that go parabolic. URNJ lets you tap into that explosive behavior without gambling on individual penny stocks. And coming up next, an ETF that fuses nuclear power with a twist most investors completely overlook. NLR. If URNJ was the wild child, NLR is the calm professional of the nuclear world. Officially called the Van Eck Uranium and Nuclear Energy ETF, NLR takes a balanced approach, not just mining or exploration, but utilities, reactor operators, infrastructure firms, and fuel cycle companies. In short, while others are chasing uranium drills, NLR owns the companies already generating power and cash flow. With over $3 billion in assets, it's one of the biggest nuclear ETFs out there. But here's the kicker. Its expense ratio is only 0.56%, the lowest on our list, which compounds into higher long-term returns. Because it holds more established utilities and fewer volatile miners, it's steadier, less sensitive to short-term uranium prices. Sure, that means slower gains when the market spikes, but much smoother rides during pullbacks. Think of NLR as your sleep-at-night nuclear ETF, the one for investors who want exposure to the atomic future without living through daily heart attacks. A steady foundation for long-term believers in nuclear power. And up next, our fifth ETF takes nuclear energy investing in a completely different direction. URNM. If you want the purest uranium exposure, URNM is it. Officially the Sprott Uranium Miners ETF, this fund strips away everything else. No utilities, no side businesses, no distractions. Its mission is simple. Own the companies digging, developing, and holding the world's uranium supply. With over $2 billion in assets, URNM has become one of the fastest-growing funds in the nuclear space, big enough for institutions, yet still explosive when prices move. The 0.75% expense ratio gets you direct access to producers like Cameco and Kazatomprom, plus developers and even physical uranium trusts. That's what sets it apart from URA and URNJ. But don't mistake it for safety. URNM lives and dies by the uranium price cycle. When the metal rallies, this fund rockets. When it cools, it sinks just as fast. In short, URNM trades stability for torque. If URA is the blue chip portfolio and URNJ is the startup accelerator, URNM is the high-octane bet on the commodity itself. When uranium spikes, this is the ETF that leads the entire pack. So there you have it, 5 powerful ways to ride the nuclear revolution. Whether you want the steady income of utilities, the strength of established producers, or the adrenaline rush of junior miners, one truth stands out. Nuclear energy isn't the future, it's the foundation of what's coming next. The question is, will you just watch from the sidelines? Or will you plug into the grid and take your place in this new energy era? If you found this breakdown valuable, hit that like button and tell me in the comments which ETF fits your strategy best. And don't stop here. Tap the video on your screen to unlock more game-changing investment strategies that could supercharge your portfolio.